Hi there, welcome to the channel. Today I wanted to talk about a video from a YouTube channel called Wealthion. They're known for producing content that's meant to educate investors, maybe people who are new to investing or people who are actively investing, whether on their own or with a financial firm. And the person who leads these conversations, his name is Adam Taggart, I believe. And he had a guy named Lance Roberts on, and they had a very interesting conversation, partly because Adam Taggart believes in demand destruction, in which some analysts, have been throwing that term around. What it means is literally the interest rates going high enough that it just kills demand and people just stop buying goods. And so the thing that Lance brings up is he gets kind of annoyed with Adam, and Lance says that the market's already priced in the end of the world. And it's a very dramatic quote that from him. And I know he's being melodramatic because he's sick of Adam talking about demand destruction. The thing is, though, is that no, the market's doesn't have that pricing because obviously if the world was ending, literally, stocks wouldn't even matter, money wouldn't matter, everything would be valued at zero, and we would just throw our hands in the air and forget the stock market ever existed, because that doesn't matter when you're trying to survive. The point is that his comment got me thinking, okay, so, stocks have been dropping, have been sliding since November of last year. Most of the activity was going on in December. And so I looked up an article from Bloomberg, and Bloomberg mentioned that in December 2021, $42.9 billion worth of stock was sold off by billionaires, which was double what was sold off in all of 2020 combined by billionaires. And we all know what happened in 2020. How far the S&P 500 fell to like 2,600 points, something like that. We all know what happened to Bitcoin and Ethereum. I mean, they were like almost worthless. Bitcoin didn't hit zero because exchanges stopped trading, because if they didn't stop trading, it would hit zero. But yeah, it's interesting that double what was sold in December alone was double what was sold in all of 2020. So of course, if you think about it, that's going to cause a slide in equity prices. But it's also, we're not living in a normal correction because of that. We're not seeing retail investors or institutional investors selling off just yet. We see asset reallocation. People have switched to energy stocks, ETFs have gone up. I think it was like 50% this year, something like that, from what I read. And then everything else has been negative. So you have like energy commodities. Commodities aren't positive on average, but there are a ton of ETFs or funds that have been doing very well. And so I thought it was interesting that, because of this sell-off, it was one of the triggers that started this decline in value of equities. And it's also, came back, and bit, the FANG stocks. I mean, if you take a look at FANG stocks, they have, specifically Netflix, poor Netflix, has suffered greatly. And you're starting to see people actually pricing things as they should be, because we've seen all these high PE ratios, and we know that, a PE ratio of 25 or 50 is not reasonable. Okay? It's not. But you have to price things as they should be. And even, I think it was another Wealthion video I was watching, and PE ratios, it could have been the same one, I don't remember. But one of the guests goes, PE ratios are still higher than they were in 2019. So it's funny that they've declined, but they're still higher than 2019. In 2019, they were still overvalued. So equities are still being overvalued. But it got me thinking, okay, so we have stocks are sliding, but they seem to, balance out. At least last week they were balanced out. They weren't falling dramatically like they had been for the past couple months. And so what's the trigger going to be that's going to cause the next slide? Because we hit a bottom, it's not the bottom, and what people always ask is, where is the bottom? How bad is it going to get? And I'm not going to know that. You're not going to know that for sure. No one's going to know that for sure. And I can only give my opinion. And so, you look at banks, and banks have been operating at low interest rates, almost near zero interest rates for years. Since 2008. They have gone up slightly in different periods, but especially now. And what I mean by now, I mean by the last 2 years, they were literally operating at almost 0%, 0 to 1%. And so how do you go from operating at such low interest rates to higher than average interest rates from the past 15, 16 years? And you have to realize that their workforce might not know. Who knows, whether it's half their workforce or whether it's, 75%, 30% of their workforce has never actually had experience working with higher interest rates, with normal interest rates, 5, 6, 7, 8% interest rates, which is interesting to think about, right? You have to think about it too. People have lived in these low interest rate environments for so long, for 10, 15, 20 years. With quantitative easing, because quantitative easing has been around since the 80s, I can bet you that. It has. It's just now it's being amplified because we're printing money like crazy. We're printing money for things beyond just economic recessions, for supplying the government with money for their social programs, for their little spending sprees. I did another video a couple days ago that highlighted this, that the government spent 30 or 40% more than what it generated in revenue. So we're fiscally irresponsible. Our government is operating like it's a little citizen with a credit card and it's swiping. And that's not okay. And the Federal Reserve sees that. And the Federal Reserve sees that we're not producing more output than the market is being supplied with money. You're only going to get paid if you do work. And there's not enough work. There's no quantitative way of defining how much work there is out there, how much production there is. And so interest rates are going to rise, right? I think there's going to be a real period of stagflation where interest rates will continue rising because the Fed wants to combat inflation. And, people are going to lose their jobs because interest rates will rise. Some businesses won't be able to operate at the higher interest rates, I should say. Those businesses will go bust. People lose their jobs, and you'll have people losing their jobs as inflation continues to climb, as interest rates continue to climb. So it's going to be hard to borrow money. People are going to need to borrow more money than ever before, and they won't have access. They'll either have access to it or they'll just have to pay more and suffer more for that access to liquidity, not liquidity, to credit. So, and it will be this period of stagflation until, that will be the trigger. There will be a point where interest rates will hit a certain point, a certain percentage, we won't know, what that percentage is. It could be, that percentage could come out by the end of this year. It could come out next year in March. It could be whenever the Federal Reserve hikes its interest rates again. And then the economy will literally grind to a halt, a massive halt. And so many people lose their jobs. So many people won't be able to pay their mortgages. The expensive mortgages that they got in 2020, 2021, from switching their careers so many times, from switching jobs so many times, they didn't build a good reputation with their employer or didn't have enough time to. That's going to also aid in losing their jobs. So they're not going to have any good references because they kept bellhopping to different jobs. And so they're sacrificing short-term gain for, long-term suffering because these people aren't building good relationships with their employers because they're leaving so often. So these same people, they're going to lose their mortgages. They're going to default on their debt. I could see a housing crash happen. Just like in 2008, but very different because it will be people who can't afford their mortgages not because of bad loans, but because they won't be able to pay them. They don't have jobs. They don't have the income. And so it's just going to create a spiral. People won't be able to pay their mortgages. Maybe they cash out on investments. Maybe people freak out because they're seeing the numbers come in. So the stock market's going to crash as the bond market crashes. And what's going to happen when the Federal Reserve can't bail them out? Excuse me, not the Federal Reserve, the federal government can't bail them out because the Federal Reserve won't print more money for them. So you have this chaotic flip where, if the Federal Reserve actually wants to go through with this, if they're not going to back out of their plan, they're going to literally cause a depression. The federal government won't be able to supply people with the public services that they've been supporting off of credit this whole time. Credit, money that they owe to the Federal Reserve. Mind you, they owe money to the Federal Reserve. People lose their jobs. That means that the federal government isn't getting any income. Businesses won't be paying taxes. And by the way, I just want to say this, a fourth of the government's revenue, or half of the government, I think it's half the government's revenue comes from income taxes, from businesses and individuals. And so if half of it's coming from people and people losing their jobs or people making less money, the Federal Reserve or federal government won't be able to make payments to the Federal Reserve. What's going to happen then? It'll be interesting to see. As the Federal Reserve is also selling off their balance sheet, it's going to be crazy. Very crazy, tumultuous times. So that's my 2 cents. That's my opinion. Thank you guys for listening.